Greetings, it is Friday, March 7th. In this video, I'm going to make a strong case for why I believe we could see some relief in the markets coming up, despite all the turmoil that we've been experiencing over the last month or two. And right off the bat, I will say I have some contrarian views compared to what most economists are predicting right now. And I'm certainly not an economist. That said, I will be covering a lot of data points that support my thesis. But of course, nothing in this video is financial advice, and you should always do your own research. If you haven't already, please make sure to subscribe. The first thing, though, I want to touch on really quick is this fear and greed index. Obviously, the market has been getting absolutely wrecked. If you haven't watched my last video, though, where I covered the fear and greed index and some of the correlations with market tops and market bottoms, I highly recommend checking that out. We are currently in a very fearful state, sitting at 25 extreme fear. One thing I will just touch on is that we don't generally stay down here very long. We normally do see a bounce. I expect that we will see a bounce sooner than later. I know there are a lot of catalysts that are coming up right now. We have the White House summit. We also have the expectation of the strategic crypto reserve. And it sounds like now the Bitcoin reserve is going to be separate. Some of the different altcoins and different projects might go into a sovereign wealth fund. We'll have to wait and see what happens there. I know people are very bullish. That is a very bullish thing. It's the same thing with the regulatory environment, with the SEC dropping pretty much every case that had been brought by the Biden administration against the crypto industry has essentially been dropped, like all of them in the last couple of weeks. But there is one thing I want to bring up, and I know people don't want to hear this, but when you look at the total crypto market cap, and I think this is worth pointing out, unfortunately, I believe a lot of this stuff has already more or less been baked into the market, okay? You look at right after the election, this was literally directly after the election, we saw this huge surge up, and we've been kind of in this range. Yeah, we've had some corrections. That has to do with obviously some of the tariff stuff that we're seeing, and I will touch on that absolutely later in the video. But a lot of that, when Trump campaigned, one of the things he was talking about was a crypto reserve. He talked about opening up the regulatory environment. Why do you think we had this big surge, this huge run up in the crypto market cap following the election? Well, because people were expecting those things to happen. So, yeah, this is great news, but I think we've already seen some of that in the current market cap. So people that are calling for $150,000 Bitcoin on Friday, I believe people are going to be a little bit disappointed, unfortunately, if that's the stance that you're taking. Now, looking further out, yes, okay, this is super bullish in the longer term when the U.S. starts buying Bitcoin, right? When other countries inevitably follow suit and start buying, it looks like some states are about to pass Bitcoin, legislation. All great things. The regulatory environment opening up, all great things. I think future price action, as we start to see that go into effect, is going to be positively impacted. And you better believe that people that have been on the sidelines, older money especially, they're going to start asking their financial advisor, why they don't have 1% to 2% allocation to Bitcoin. These things are all going to come, in my opinion. But when I'm talking about the short term, the resumption of the bull run, and the one that we've been hoping for and expecting with alt season and all of that, unfortunately, I think that we're going to need a lot more. And I'm talking about the macro environment needs to cooperate, okay? Because there's a lot going on when it comes to the broader economy. And those are the things I'm really going to focus on in this video. For one, from a global perspective, we are seeing that the M2 money supply, liquidity in the markets is moving in the right direction. That's a good thing. You see this overlay with Bitcoin and liquidity in the global markets. There is certainly correlation there. Generally, what you see is after liquidity in the markets expands, 30 to 60 days later, you'll see that the crypto markets tend to rally from that. Okay, so that's something we should see in the near future. That's a very good thing, something to look forward to for sure. But the main question is, what about the US? Okay, what about the Fed? And I'm talking about dropping rates and quantitative easing. Is that going to take place? Now, why does it matter though for rates to drop. Why is that good for crypto? Well, when you have lower rates, it stimulates the economy. You think about right now, people can put money in money markets and get a pretty good return. So there are certain savings accounts that are giving a good return. Well, if rates drop and people can no longer park their assets in those risk-free areas and get a decent return, they're a lot more likely to put money in equities. They're a lot more likely to put money in risk on assets like crypto. It's also good for the broader economy. For one, companies that, especially in like the tech sector or startup space, where they had to lay off lots of people because as rates went up, it got a lot more expensive for them to access capital. They had to really start focusing on their profit centers and shut down a lot of the more speculative verticals. Well, that led to a lot of layoffs. By making money cheap again, companies can start getting more aggressive on growth. So that's going to stimulate the job market. When the job market gets stimulated, people can spend more money, and that is good for the economy. They can also invest more. You'll also see the housing market open up. As mortgage rates come down, a lot of these people are on the sideline right now renting, because renting right now is cheaper than buying. But as mortgage rates come down, now you can have more buyers into the market. And then there's the supply side of that too. There's a lot of people that are stuck in their homes. They have mortgages from years ago at low interest rates. They have not wanted to sell their home and then have to look to buy a house with a higher mortgage rate. So all that opens up as interest rates come down. So that's why it's super important. And risk on assets tend to thrive in a low interest rate quantitative easing environment. Trump has made it very clear what he wants.
With oil prices going down, I'll demand that interest rates drop immediately, and likewise, they should be dropping all over the world.
But Jerome Powell has also made it very clear where he stands on this.
But I'm more concerned with the president's statement at 7:58 this morning, where he said interest rates should be lowered. He said it. Will that influence what the Fed actually does?
I, as a practice, never comment on anything the president says, but I think people can be confident that we'll continue to keep our heads down, do our work, make our decisions based on what's happening in the economy, the outlook,
And
the balance of
statements
risks.
by elected
No
officials
change.
are not among the things that cause you to act one way or the other.
That's correct.
Now, I have to say, I do side with Jerome Powell on this to an extent. The Fed is supposed to be separate from having any political leaning, okay? And they should be reading what the economy is doing before making any changes. The question is, what would it take for Jerome Powell to start lowering rates and incorporate quantitative easing?
Policy is not on a preset course. If the economy remains strong, but inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly.
I think there's really two things to be looking at right now. And number one is inflation needs to come down. And number two is if there are recession signals that are being triggered, that are flashing, those are things that Jerome Powell will not be able to ignore. And I'm going to cover some of those things that are happening in the economy right now and why I do believe we will start to see rates drop sooner than people have anticipated, and why I would believe we also see more rate cuts than a lot of people have anticipated to this point. And don't forget, it was not long ago coming into this year that there are a lot of economists that were expecting we'd have zero cuts this year, and things are certainly shifting. I think that some of this is that Trump is pushing the envelope with some of the things he's doing, but I'm going to break it all down. But first, let's talk about why there's some reasons to be optimistic about inflation. In that clip that I played with Trump talking about oil prices being down and wanting interest rates to come down, is there credence to that? Well, if you look here, there's a very strong correlation between oil prices and inflation. And it makes sense because oil prices have a strong correlation with the cost of goods and services. You think about fuel costs for shipping. Oil is also necessary for manufacturing. It's also found in a lot of products in our lives, especially plastics. And here's a fun fact for you. Every tire has on average 7 gallons of oil in it. So the price of oil has a very direct impact on CPI, or the Consumer Price Index. And you'll see here, the price of oil has been coming down. That's a very good thing when it comes to inflation. Now, there's a lot of reasons for this. Russia agreed recently to increase production for the first time since 2022. Trump has been putting pressure on OPEC. I also believe that there are some fears about a recession right now, so that does push prices down. So this is something to absolutely keep an eye on. But if oil prices can remain low like this, that's very good for the outlook on inflation coming down. The other thing I want to touch on is the cost of rent. And we're seeing, this is a report from Realtor.com on their December rent report. We're seeing that rents are on the downtrend, and especially when it comes to new rents. We're seeing on this black line right here, might be hard to see there, but we are starting to see a major drop off there. And when you look at it city to city, these cities, Austin, Vegas, Phoenix, are getting hit the hardest, but there are a lot of cities where this is coming down. This is really important though, because when you look at CPI, a consumer price index, which is how the government measures inflation, 35% roughly of that calculation comes from housing costs or shelter. And that all comes down to rent. And you might be asking, well, what about homeowners? Well, they actually use what's called the owner's equivalent rent. So they estimate what the rent cost would be for a home. So rent is a huge factor. Now, when you look at trueflation, and again, the government uses CPI or consumer price index, trueflation is a different measure of inflation. It has a lot more data points, but it tends to be more real time. CPI tends to lag because there's a lot of manual collection. But you'll see here with trueflation, which in many cases is a leading indicator of where CPI is going, we've seen a massive drop off here, recently measuring at 1.3%. So I think it is fair to say there are reasons to be optimistic about CPI coming down in the near term. And to put that in perspective, by the way, the goal of the Fed is to hit 2% on the CPI. And 2% is the factor that pretty much every central bank, every major government across the world targets for their annual inflation. So if we do see that start to drop in the near term, that would certainly be a reason for Jerome Powell to start considering dropping rates. Now, the other thing I mentioned was, fears of a recession. And I want to bring up the tariff situation. There are really 3 countries right now where the trade war is escalating. And of course, those 3 countries happen to be our biggest trade partners. These are the percentage of imports that come from these different countries. Mexico is actually our largest trade partner now at 16%. China's at 14%, and Canada is at 13%. So talking about China first, we actually put tariffs on them back in Trump's first presidency. And under Biden, we didn't get rid of those tariffs. We actually increased some of the tariffs against China. The main thing I want to touch on here is we've really reduced our reliance on China for imports. Back in 2018, we were at 21.6% of our total imports come from China. We are down to 13.4% now, according to the US's metrics, at least. China does claim that we import more than that. But the main thing is that we are reducing reliance. So I think while it could have an impact, I do not believe it's going to be as big of an impact as some people are making out to be. But that does bring me to Canada and Mexico. Now, I believe both sides are going to be pretty motivated to get something done here. That's not to say we're not going to have short-term pain. We're already seeing that. I mean, the stock market has been getting wrecked. The crypto markets have been getting wrecked as well. But when you start to look at how this is going to impact the other countries, let's start with Canada, for example. Roughly 76% of their exports go to the US, and we represent about 20% of their country's total GDP. Okay, so yes, it's going to impact us, but it's going to have a massive impact on Canada's economy. So I do believe both sides are going to want to get something done here. Now, on Trump's end, I believe part of this is certainly, creating fair trade, securing the border. But I also believe that there is a bigger picture item here that he is looking to force Jerome Powell's hand to start lowering rates. Now, talking about Mexico, it's even worse for them. Okay. 78% of Mexico's exports go to the US. That's representative of 37% of their country's GDP. So I don't think there's any way either of these countries are going to want to have this drawn out very long. Now, do I expect them to meet all of Trump's demands? I would be pretty surprised if they do. But I do think that when Jerome Powell starts to lower rates, Trump will likely be a lot more open to going to the negotiating table with them. And perhaps the biggest factor here is that Jim Cramer came out and said that he does not have optimism that there is a deal on the horizon. So, as we all know, the Jim Cramer effect is very real. Now, I know there's a lot of concern about inflation from these tariffs, but if you look at the 10-year Treasury, we are seeing that drop, okay, which would indicate there's more concern over a potential recession. Because I believe the thought process here is that as these tariffs go into effect, consumer spending is going to drop off, and that's going to impact GDP. And one thing to realize here is that roughly 70% of the GDP of the US is based on consumer spending. We love to spend money. And this is actually evidenced here as some of the GDP forecasts are coming out. Originally we were expecting a 2.3% increase in GDP. Some of the stuff that's coming out right now is looking at a negative 2.8%. I mean, that is a massive swing. If you don't think that Jerome Powell's paying attention to that, you should think again, because these are the exact things that he's going to be considering when it comes to dropping rates, when it comes to quantitative easing. So again, I believe these tariffs, short-term problem, in my opinion. I think Trump's being very aggressive with them and is partly being used to force Jerome Powell. Now, I will also say part of this forecast on GDP has to do with the Doge cuts, and that's what I'm going to talk about next. But before I get into that, if you haven't subscribed, please make sure to do so. And by the way, if you like this shirt that makes something every day, I think it's a pretty good representation of us in the DePIN trenches. We're out there deploying, we're out there building, making something happen every day. These are made by one of my buddies. He's a Helium OG. I'll have it linked below. All right, talking about the Doge cuts. This is not a new playbook. In fact, check out this clip of Bill Clinton.
First thing we have to do, and I mean the first, is to cut inessential government spending. I've been president 4 weeks. And I've been president 4 weeks, and I've found things that I wouldn't have believed. We have worked very hard to cut government spending and to bring the deficit under control. In the last 2 years, we have made a good beginning. We have begun to shrink the federal government's bureaucracy to its smallest size in 30 years. The workforce of the federal government is already almost 100,000 below where it was on the day we were inaugurated. We are on the way to a reduction of 272,000 positions.
Now, I'm definitely not saying that I agree with the way this administration is going about it, but I do think we're finally going to see a true representation of where the job market is. Because last year, we kept seeing reports revised. In fact, it's estimated there were about 589,000 fewer jobs last year than what was originally reported. And one thing to call out here is that the private sector is a true representation of the strength of the job market. And one of the things we saw under the prior administration is that they added a ton of government jobs. And that really masked the true state of the job market between that and the overstating of the actual employment numbers. Now, government jobs are important, okay? I'm not debating that. But when you add that many government jobs, I would have to think that there are some jobs that are unnecessary, and having some cuts is not necessarily a bad thing. The fact of the matter is this is going to lead to higher unemployment numbers. And this is one of the biggest indicators that Jerome Powell is going to look at. And this is a big deal because as people are unemployed, that means less discretionary spending. And it also means less GDP. Okay. Again, 70% of our GDP is tied to consumer spending. So unemployment numbers ticking up is a clear-cut sign that it's time to start cutting rates. And I do believe that, yes, part of it is cutting waste. But I also think that they're being super aggressive on the front end because they're, again, looking to force Jerome Powell's hand to start cutting rates. Now, as they start to see rate cuts and quantitative easing take place, I would expect that they will start to slow down. And the real big question is going to be looking further out, is the private sector going to be able to grow? Bill Clinton did a great job of that in being able to pick up the slack from the government cuts, grow the private sector. And that is what remains to be seen. And unfortunately, I have to say, I don't think this is going to happen overnight. A lot of these companies right now that have, laid people off are still concerned about a recession. I don't think they're going to go right back into growth mode and hiring mode immediately. So again, we could have some short-term pain when it comes to unemployment for a little while before things pick up there. And to show you what I mean, there are now economists that are predicting a 40% chance of recession in 2025. Now, coming into this year, it was like 10%. So, I think the combination of these tariffs, these government layoffs, and there are other factors as well, obviously, but I think that is what's pushing up the chances of this recession. But it's also what Jerome Powell is going to be paying attention to when it comes to rate cuts. So, if we do see CPI coming down, we see unemployment going up, we see GDP contracting, these are all things that will really give Jerome Powell no choice. And this is what everyone should be looking at. This is the upcoming FOMC meeting. They have 8 meetings per year. This is when they choose whether or not to change the Fed rate. And the next session is coming up on March 18th and 19th. This is going to be the most important Fed meeting we've had in a very long time. Now, I will say I don't expect Jerome Powell to cut rates in this session. In fact, I know this is going to sound weird, but I think that would actually be a negative thing if he does, because the markets don't like surprises. If he cuts rates in this session, I believe the train of thought is going to be that things must be a lot worse than we realize. So the thing to really pay attention to is, what does Jerome Powell say coming out of this meeting? What is this sentiment? Is it that we're going to have rate cuts, more rate cuts than we expected? And my prediction is that we could start seeing rate cuts starting May. Okay. And that would be sooner than we anticipated. Again, I don't think it's going to happen in March. I could be wrong. But if the sentiment leaving that meeting is that we will start to see rate cuts in May, and on top of that, I would not be surprised if we could have up to as many as 4 cuts this year. I believe the market is going to start pricing this in. If that does happen, I would expect to start seeing a rally in the stock and crypto markets, especially if the tariff situation gets resolved and DOGE starts to slow down on the government cuts. And there are 2 other catalysts that I want to touch on that could come into play here. And I don't think they're fully necessary, but if they do happen, we could see an epic bull run here, especially when it comes to retail. Because for us to really have the altcoin season that we're hoping for, I don't believe it can just be institutional buyers. I believe that we're going to have retail re-enter the space in a big way. Number one is there are some rumors that we could see an announcement that capital gains tax on US-based crypto could be eliminated. Okay, this would be a really bullish signal. I don't think this is necessarily being baked in. These rumors have been flying for a while, but if that becomes official, I think that would be really big. The other one is one that I don't necessarily agree with, and that is that there could be a stimulus check sent out that's a percentage of the DOGE savings from the cuts they've had. The number being thrown around is that could be $5,000 that go out to taxpayers. Here's why I don't necessarily agree with this. For one, we're talking about cutting down the deficit. Sending out $5,000 checks to a bunch of people does not jive with that. But looking at this from a broader perspective, if you remember back in COVID, when we had the stimulus checks go out, we saw retail enter the crypto space like we'd never seen before. So if we start seeing money like this distributed amongst people, I would imagine that we're going to see a lot of liquidity enter both the stock and crypto markets. So in summary, all eyes are going to be on Jerome Powell. And he's going to have to act. And if he doesn't act, there is a chance that we go into a recession. And I don't think that Jerome Powell wants that to happen. So let me know what you think in the comments below. As always, I appreciate your viewership. Signing off, this is Bradley Meyer with the DePIN Connection.